Hi friends, it's Brad Brain. Today we're going to talk about life insurance. When it comes to life insurance, there's two main types. There's term insurance, there's permanent insurance. You do not need me to tell you that. You can Google that for yourself. What I'm going to share with you is some insights from my 25 years as a licensed life insurance agent. And one of the things I'll tell you is that in a lot of cases, people underestimate how long they will need coverage for. This video stems from a recent client experience I had where the fellow was, I don't know, surprised, maybe disappointed, I don't know, but his insurance premiums went up. Well, that was totally predictable. It was not a surprise to me, and it shouldn't have been a surprise to him because he bought a term 10 insurance policy, which means at the end of 10 years, you still have coverage, but it goes up in price. I'll show you what I mean. So now, forgive me, I'm no artist, but bear with me. Okay, so if you have a term 10 policy, it means that your premiums will be in force for 10 years, and at the end of the 10 years, you still have coverage, but it goes up in price. And then it'll go for 10 years and then go up, and 10 years and go up. And what that means is if you go through a couple of these renewals, you're actually looking at some fairly expensive coverage. Okay, now, why would we do that? I'll tell you why. You don't always need coverage that will last your lifetime. If why you're buying insurance is because you have young kids that are dependent on you, presumably over time those young kids will grow up, they'll become independent, they're not dependent on you anymore. So in that case, you may not need coverage that's going to last for 30 or 40 years. Or the other main reason why term insurance can be appropriate is mortgages. Right? In time, mortgages get paid off, so we don't necessarily need coverage that's going to last forever. Now here's another insight though, and that is a lot of times people start out thinking about these temporary needs, about something like protecting your income in case something bad happens, then there'll be resources there to make sure the kids are okay or the mortgage gets paid off. But lots of times needs are going to evolve over time, and we will shift from income protection to estate planning. And I'll tell you this for a fact. Term insurance is a lousy tool for estate planning, in part because we've got this series of renewals at higher and higher prices. But the other thing is eventually a term policy like this will, generally speaking, expire. Maybe not till age 80, but if you live past age 80, this policy won't do you any good. Okay, there's a variation on this that is really attractive for the right situation, and that is a term 20 policy. Same idea, different pricing. What happens now is you will start at a little bit of higher price initially, but we'll lock in for 20 years before we look at a price increase. Okay, so same idea, just a little bit different graph here. So a little bit more expensive in the first decade, less expensive in the second decade. If you're thinking about a 20-year time horizon, term 20 is often more attractive. Here's the part. I ran into this all the time. I've been doing it for 25 years now, so I'm seeing people who have term 20 policies renew, and they thought they'd be done by now, but they're not. And this is not fun. This is not fun to be at year 20 and you see the price hike, okay? So if you either have needs that aren't not temporary, which basically now we're looking for the most part at estate planning. What we want to check out is now, let's lose this color here, level premiums, okay? So what happens now is you can lock in your premiums when you're young and healthy. It will be more expensive in the initial years over a term policy, but over the course of the lifetime of the policy, will be less expensive than having these term ones go up and up and up. All right, now, one other point to point out. Lots of times we go with term to start with because, it's just practical, right? Usually when people are looking at insurance, they've got all sorts of other stuff that they need to spend money on, like kids and mortgages and everything else in life. And so what that means is we might like whole life or permanent products, but it's just not in the budget. Well, what you can do is you can get a term policy and keep your costs down to start with, and then as your needs change and maybe as your financial situation changes, you can convert your term policy to a permanent policy down the road, and typically you don't have to go through underwriting again. It's a very, very, very valuable feature of the product. Now, here's a little bit of a Brad Brain's backstory. Over my career, I have kind of had different preferences. Initially, when I was young and, to be honest, a bit naive, I kind of accepted that buy term and invest the difference slogan, which is a slogan, by the way. This is made up by marketers, not by insurance people. buy term and invest the difference, I took it to heart. And I'm not saying term insurance is bad. It's not at all bad. It's like anything. You want to buy the right product for the situation, right? And term insurance is fantastic for temporary needs. But the whole buy term and invest the difference, that doesn't always work out. So I've used universal life along the way, and that's certainly good. Usually, though, universal life illustrations, there's a bit of a flaw in them, and what they'll assume is level performance through the entire contract. You don't always get that, and there's been issues with universal life contracts that were illustrated with overly generous assumptions. So here's what I want to show you now, and I just got to pull something up here. I want to show you whole life, because a lot of times people don't give this stuff the credit it's due. Make it a little bigger so you can see it. Now, this is one particular company, Equitable Life. I like Equitable. There's other companies too. They're going to have very similar performance over time, by the way. This is the dividends of Equitable Life over time, right? And so what we've got here is going back 25 years. It was paying 10%, and then through the time, okay, this is 2019, 6.2%. Off the top of my head, I think they're in there somewhere. Maybe it's like 6 or something, but it's, it's not like it's radically different today's terms. I might be wrong on that. I could be thinking about a different company. It doesn't really matter for today. So here's the thing. We're comparing it to the Toronto Stock Exchange, because a lot of times people will think, well, 6%, that sounds okay, but maybe I can make 10% on my stocks. Wrong comparison. For one, one's an investment, one's an insurance policy. But the other thing is, yeah, and trust me, I'm an investment guy. That's my bread and butter. So I'm not discouraging equity investments. I love it. But one of the things that goes along with equity investments is you will get variability in your returns, right? You get some good years, you get some bad years. So here, let me just find some stuff here. Like here's 28%, but there's negative 12. Well, back-to-back negative 12s, right? Here's a negative 33. So here's the deal with this is over this 25-year time period, the Toronto Stock Exchange did 8.3%, but it did it with all that variability. You can see it here in standard deviation. Don't worry about that. You can tell that 16% is a lot bigger than 1% as a glimmer at how this is so much more stable than the stock market. So, okay, so 7.9%, the 25-year number for Equitable Life participating whole life policy, 8.3% for this unguaranteed investment. So we can compare these other investments here, government accounted bonds, GICs. Here's something that's cool. GICs are actually more volatile than whole life insurance, if you can believe it. And what that means is that, yes, your principal doesn't fluctuate on GICs, but in the context of this thing here, GICs have fallen more than Equitable Life, whole life participating the dividends on this thing. Okay, so here's an analogy. Think of yourself out golfing. This guy here, it just keeps hitting the ball right down the middle of the fairway. Very consistent. And the results at the end of the game are pretty attractive. That's whole life insurance. Now, it's got to fit. And I wouldn't buy this purely as an investment, but if you have estate planning needs, and another alternative is if you can look at this as an asset all by itself. If you already have a bunch of investments that are designed for growth, and you've got money that you're never going to spend, it's going to go to the kids sooner or later. Rather than having it sitting around in a GIC, we can channel that through an insurance contract and make a much more substantial estate planning impact than just having the money sitting around in a taxable GIC earning at these rates hardly nothing at all, right? So the other part that I like about whole life versus universal life is there's some guarantees on the contract. Now, it's not that 6% is guaranteed, but there are some guarantees on the contract. And what that means then is now when we look at product that's paying around 6% and comes with some guarantees, well, there are other products that have guarantees, but they're not paying 6%. There are other products that can do 6%, but they don't have guarantees, right? This fits a really interesting space in the marketplace. Okay, so there you go. Some insights from my career as a life insurance agent. If you got any questions, if there's anything we can do, please let us know. We're here to help. I'm Brad Brain. Be healthy. Take care. Bye-bye.